Yeah, great points. And I think that's a pretty good segue into one of my next questions, which, I think you've talked in a couple different bullet points, but if you were to give, like a quick stump speech, concise summary, what are some of the primary differences between planning your investments and doing all this financial planning when you're a little bit younger versus when you are about to retire? I know you talked about being more conservative and distributions, but what are some key bullet points that change when you become of retirement age?
Right. I mean, I think the cliches are all true, right? Buy low, sell high, diversify. Like those are things that are not going anywhere. So whether you're 25 years old and just starting out, or whether you're 65 years old and then you're investing, we want those things. What really changes, the big bullet point, is time to distribution. It's the market is going to move. It's going to go up and down. There's nothing we can do about that. How do I limit that volatility from when I need to capitalize on that volatility? So, like I said before, if you have less than a 1 year time horizon to use those funds, they should be invested in something that is not at risk, right? We're talking cash. We're talking something like a high interest savings account or something along those lines. 2 to 10 years, I want to think about, bonds, things that are yielding dividends, things that are not going to fluctuate with the market more. And anything with 10-year horizon, that's when we're really starting to explore equities and things of that nature. If you're 25 years old, you're pretty much in equities, right? When you look at the overall market, let's take the S&P 500 as that index, for example, and you look at it, yes, it goes up and there's times of recessions, and 2008 happens, it drops back down. How long does it take for it to come back and then exceed from that previous peak? It might be 3 to 4 years. In the longest case, it might be 7. But again, if I have that 10-year time horizon, I have time to allow it to recover, meaning that I could stay in the market. I don't have to go to cash and then put it back in and be right twice when I pulled out and then got back in. And that's actually typically how you lose. So how do we design a strategy that's here to weather these recessions? That's here because we know when we're pulling money, I'm not chasing returns, I'm chasing goals. And by chasing the goals that we have, I'm actually able to develop an investment strategy that I don't really care what the market does. We know that we're in the right buckets, that when it comes time to pull that money, that we're going to be in the right place with it, and you're going to succeed in your retirement.
Yeah, that's all great information.
Thanks again for tuning in to Talking Retirement on YouTube. Please like and subscribe to keep up with the podcast, and check out all the other great educational content we have on the NJ Life and Health YouTube channel. If you'd like to listen to an audio version of the podcast, you can find us on Spotify, Apple Podcasts, and pretty much all other major podcasting platforms. For daily senior tips and to keep up with us at NJ Life and Health, follow us on all major social media platforms such as Instagram, Facebook, and TikTok at NJ Life and Health. And of course, if you'd like someone in your corner to help you with Medicare and life insurance, we would love to talk to you. Visit our website at www.njlifeandhealth.com or call our office in Toms River, New Jersey at 848-226-6897. We'd love to set you up with an appointment with one of our Medicare and life insurance brokers, and we are licensed in a lot of other states besides New Jersey. So no matter where you are, there's a chance we can help you out. Anyway, hope you enjoyed this podcast, and we'll see you in the next episode.